Assets. Asset represent property owned, which usually provides benefit in the future. Assets have debit balance. Anything of material, value, or usefulness that is owned by an entity is termed as asset. It also results into future cash flows to an entity. An asset is a resource that is controlled by the entity as a result of past events, for example, purchase or self-creation, and from which future economic benefits, inflows of cash or other assets are expected. Such assets can be classified as under fixed asset, investment, current asset, fictitious asset, contingent asset. Let's understand each of these in separately. Fixed assets. The fixed or long-term assets are those assets which are purchased to use them for a long period. These are not meant for resale. The purpose of buying such assets is to generate returns for a long period, and they remain within the organization as long as they are usable and capable of generating revenue. Of course, when these assets become old or unusable, or their productivity reduces drastically, they can be disposed off and replaced with new assets. Fixed assets, further classified into tangible fixed assets and intangible fixed assets. Tangible fixed assets like land, building, machinery, and intangible fixed assets like trademark and software. Tangible fixed assets are those fixed assets which are physical in nature. They can be seen and touched. Plant, machinery, buildings, furniture, office equipments. These are some of the examples of tangible fixed assets. Intangible fixed assets are those fixed assets which are not physical in nature and cannot be seen or touched. Like goodwill, copyrights, trademarks are some of the examples of intangible fixed assets. Fixed assets can be used productively during their useful life. Since they have limited life, the cost will expire along with the expiration of their useful life. Thus, value of the asset is reduced in proportion to the expired life of the asset. Depreciation is the continuous and permanent decline in the value of fixed assets due to usage, efflux of time, and obsolescence. Fixed assets are valued at written down value, cost less, accumulated depreciation. Investments. Investments refer to money invested outside normal business. They are usually securities of one company held by another company in order to generate some return. Investment can be classified on the basis of its nature as follows: long-term investment and short-term investment. Long-term investments are usually intended to be held more than 1 year. Some examples are shares, debentures, land, and gold. Short-term investments are intended to be held for less than 1 year, like liquid funds, money market instruments, etc. Current assets. Current assets are the assets that are used to fund a day-to-day operations and pay ongoing expenses. In addition to cash and bank balance, the debtors, bills receivable, and closing stock are the examples of current assets. Current assets can be easily understood with the help of operating cycle. The operating cycle is the duration of time taken by a unit of cash to circulate through the business operations and return back as cash. Below is the diagram which represents cyclical flow of current assets. Cash in bank account. Raw material procurement by using cash. Work in progress by using raw material. Finished goods after completing production process Sales finished goods to debtors on credit or cash. Receivables after payment received from debtors. Cash in bank account. The raw materials are purchased and put into process. Once they get converted into finished goods, they are sold to distributors on credit basis or cash. When the collection is received, it is utilized for purchasing raw materials, and the cycle continues. Cash in bank is usually taken to include currency like foreign currency check is, or any other instruments which are easily convertible into cash. It is held for daily requirement. It also includes bank balance. Debtors represents balances receivable from customers by an organization for credit sales made. Only receivables arising from credit sale of goods or services are included in debtors. Therefore, it is also called as accounts receivables, trade receivables, or trade debtors. Bills receivable is negotiable instrument in the form of written promise from debtors towards account payable by him. Prepaid expenses are those expenses are paid in advance, such as rent, taxes, insurance premium. They are considered as current assets because if these prepayments had not been made, it would have required a cash payment during next period. Stock is another important type of current assets. It includes raw material, work in progress, as well as finished goods. Fictitious assets. Fictitious assets are not assets in real sense, though they are disclosed on asset side of balance sheet. They represent losses which are not written off, like company formation expenses, shares and debentures, issue expenses, etc. Contingent assets. These are those assets' existence and value of which depends upon occurrence of specific event or on performance of specific act, like compensation claimed from service provider, which may be received on court decision.
Thank you for watching. If you enjoyed this video, don't forget to give it a thumbs up. I'd love to hear your thoughts, so drop a comment below. And most importantly, hit that subscribe button and press the bell icon so you never miss an update.